So how are you going to make sure you don't run out of money in retirement? I'm concerned, to put it mildly. In fact, it's always been a major concern of mine as a financial advisor. You may be wondering what I'm talking about. What I'm talking about is the possibility that people miscalculate how much they can afford to spend in retirement and how long they're going to live. Over the last 15 years, I've seen more and more people wanting to start accessing their retirement funds from younger and younger ages for a variety of reasons, which will inevitably collide with us living longer. In the next 50 years, it's quite possible that people could be routinely living beyond the age of 100. So it's not difficult to foresee that there are potential problems in the future. So in April 2015, George Osborne, the then Chancellor of the Exchequer, introduced pension freedoms. Pension funds can now be accessed much more easily, and there is no longer a requirement to purchase a guaranteed income for life via an annuity. So annuities have become far less popular, and as a consequence there may be a price to pay for some in the future. Thousands of people over the age of 55 have now started to access their pension funds, and in many cases in a full 10 years before the usual date that they would start to access their pensions. That's very worrying. Early indications suggest that many people are being sensible about the amount that they're withdrawing from their pension funds, but many are not, which is almost certainly going to lead to many people running out of money during their retirement. If this is not already a worry for policymakers, it really should be. So here's the really interesting statistics. According to the Association of British Insurers, 57% of savers withdrew 1% of their savings in the first quarter of 2016. Good news so far. But 9% of those savers took more than 4% over the same period, and half of those took more than 10%. We should all be concerned about that. If they continue at that rate, their pensions funds will be completely withdrawn in 10 years. As annuity rates have fallen to historic lows, more and more people are choosing the drawdown option. But that presents investors with another problem, which they may not have considered. If funds are remain invested, it will need to be looked after and managed, unlike an annuity that requires no management in the future whatsoever. The biggest challenge facing investors is managing withdrawal of income from drawdown pensions and not running out of money before they die. There are three problems that could lead to investors running out of money, and these are: number one, taking too much too soon. This is happening already, and those that are doing it may live to regret spending too much too early. Expecting good, consistent growth. As we all know, the stock market often behaves irrationally, and it's very difficult to predict investment returns. And number three, living longer than anticipated. Life expectancy is increasing, and as such our pension fund money needs to last longer. Conventional wisdom that we're using currently suggests that income withdrawal should be sustainable throughout life if we take a withdrawal rate of less than 4% a year. But the reality is that this will not leave much margin forever. So what is sustainable? Given unpredictable investment returns and the prospect of living longer than previous generations and a more sustainable withdrawal rate of 2.5% to 3% a year, you're probably thinking that the rate is very low. The reason is quite simple. When you start to withdraw funds, a more cautious investment strategy is a more prudent approach to ensuring you don't run out of money. And here's why. Let's say you invest in a range of funds that are more speculative than cautious funds, and you withdraw 4% a year. After the first year, let's say the underlying investments have fallen by 10% in simple terms. The portfolio will now be down 14%. So it's easy to see that a combination of withdrawals and a poor investment return in 1 year, and your portfolio will have taken a big hit. So over a period of 20 years or more, there's certainly going to be a few years where the investment returns are poor, which could mean that your pension fund could run out before you die. So what's the answer? Well, in our opinion, a combination of annuity and income withdrawal is the sensible option. An annuity income should ideally cover your essential costs, and the drawdown income can be more variable, giving you the best of both worlds. If you're using drawdown, a realistic growth rate is essential to avoid running out of money. And be realistic about those investment returns. Don't forget to factor in you may live a lot longer than you thought. The subject of accessing pension money has now become the most important financial and most complex decision of a lot of people's lives. So to reduce the chances of making the mistake that could be very costly, seek professional advice from an independent financial advisor who will give you the best chance of not running out of money before you die. After all, the last thing you want to do is have to return to work when you're 75 because you've run out of pension money. My name is Martin Dodd, and I look forward to talking to you in my next video. See you on the other side.